Yeah, most significant challenge I think is just taking all data on chain and really trying to figure out what that data represents. I think just working through these different transactions, there's just so many possibilities that I think actually trying to understand everything that happens is the most difficult thing.
It's a pleasure to be here today with everyone and to be interviewing our special guest, Jozef Vogel. So showing here what we have on the itinerary today, you can see the topics that we're going to discuss. So the introduction about liquid staking, syncing to the main ledger software, liquidity pool tokens, and we're going to touch upon a bit of reporting. So on the next slide. So first off, Jozef, we just want to start off with hearing a bit of your story, how you got into crypto, what was your rabbit hole story essentially that really got you hooked to Web3.
Yeah, thanks, Richard. Thanks, Ari. Appreciate you guys having me on. And yeah, I've worked with the CryptoWorth team for a little while now and really enjoyed that experience. So happy to join today. As far as, I guess, my red pill moment, I don't really know that I had one. I came from like a very, I guess, accounting typical background, went through the audit route and all of that, all that typical accounting processes. And then I kind of wanted a different avenue. So I ended up moving down to Cayman, relocated initially to work in hedge funds and kind of got a little bit bored with that industry. It was quite saturated. So then I naturally decided to jump into one of the most hectic industries I think I could possibly have chosen. I started with a blockchain mining company that just got my interest going. From then, it really just propelled more and more, and just seeing the people within the industry, I guess. I didn't exactly know the tech at first. I was interested by it. It was something that I just wanted to know more about. And then kind of once you get down that hole, you realize how little you know. And then it's either you kind of fully commit or not. And for me, I think I was just entrenched in learning about blockchain, learning about alternative currencies, and working with the people within the industry. So I think the people I met along the way was kind of what got me super excited as well, and just working with all these different developers and everyone who just like had a natural excitement for what they were working on. I think that's really what just got me into the space.
Awesome, thank you for sharing that, Jozef. So I think we're going to get right into the nitty gritty of it. So in the next slide, we're going to go straight into the topic of liquid staking. So you've been doing this for quite a long time now with your background from Aave and Ether.fi. So this is a very interesting subject, and it's been a topic that has been evolving a lot in Web3. So given your experience, we'd love to just talk about, in your words, how you differentiate non-liquid staking versus staking reporting.
Yeah, I think you hit it on too. I think right now it's definitely the hot topic in DeFi. It's been coming on for a little while, and it's been really cool to see all the infrastructure, all the protocols build on top of this basically primitive or this consensus layer, this e-staking layer that's kind of evolved ever since we have passed a few of the big milestones in the Ethereum community. Yeah, I guess at a very high level, if we kind of look at non-liquid staking first, as with many proof of stake blockchains, typically you lock up your tokens, provide those tokens for distributed security to that network. So this is effectively non-liquid staking at its basic form. You earn some kind of yield in order to do so. You obviously have to incentivize these users to provide that security. And by engaging in non-liquid staking, you are essentially locking up your tokens and providing that security and efficiency. But during this period, your assets are, in a sense, frozen. So basically, they're not readily available. You can't convert them to cash. You can't use them to borrow against. So your tokens are locked within that ecosystem. From an accounting perspective, I guess it depends how you view this, but it does make them an illiquid asset. And then you obviously will continue to earn rewards on those. And how you do recognize those rewards is also an aspect to consider, but you won't necessarily realize that until you pull those assets out of the protocol. And then when you do so, there might be some impairment, there might be some other instances or capital gains that you have to look at. So that's where liquid staking came in. It was for users who wanted the ability to have some kind of liquidity on these assets that were locked up, because obviously in crypto or DeFi, we just want max utility, we want max composability, we want to be able to do whatever we can with our assets, and that's the beautiful thing about the system. So liquid staking basically takes the approach where you can now deposit your, let's say, ETH in this case, and in return, you get a representation saying that that ETH has been deposited and put into a validator to the beacon chain, which then goes towards securing the network. So then in doing so, you receive this liquid staking token. There's a few forms that it can come in, but as a representation of your ETH that you've deposited, you can now both earn a yield on that that you would get typically from the consensus layer or the execution layer of the Ethereum network. There's a few different ways that you get these rewards, MEV, attestations, block proposals. I think it's, we could definitely spend a whole session on that, but we'll just kind of keep it high level. So those rewards will accrue to your token. And then what's fun is there is a lot, or a big, I guess there's a lot of infrastructure now built on top of this, where these protocols are now permitting a lot of these tokens to be used for different purposes. So now I can earn yield on my ETH, I can go deposit it, I'm securing the network, I get my token back, and now I can put it in another protocol and I can borrow against it. I can do a bunch of other fun stuff. I can yield farm, I can do all the DGen DeFi stuff, or I can just simply hold the asset as well. And what's good is the way a lot of these protocols are designed is you still have full custody over those assets. So if I next day want to go around and turn around and get my ETH back, I can do so. I can just go to the protocol, I can ask for a withdrawal request, and there's a few mechanisms in how this is handled. But quite simply, I just get my ETH back, and there is not a huge level of risk. Obviously, we are kind of introducing another layer in the smart contract stack. So that's just another thing to consider as far as complexity goes. But liquid staking is come a long way, and I think it's quite simple for users to have access to this.
Perfect. Thank you for giving that background on liquid staking activity, Joseph. I think we can all agree here that it's quite easy to understand the allure of liquid staking versus, for example, non-liquid staking, right? You have your assets locked in one, the other you don't. I think it would be great if we can touch upon the caveats from doing so regarding more on the reporting side. So obviously it's going to be a little bit more complex from a financial reporting standpoint, tax reporting standpoint. Would you have a few pointers that you can maybe share with the audience on what to look for when considering how to report liquid staking?
Yeah, for sure. And I guess I didn't quite say, but yeah, it's roughly about 4% yield. So let's just go off that you get on liquid staking tokens. So obviously, if you hold ETH, if you're just long ETH, you're just subject to any kind of price fluctuations. And if you were to swap that out at a later time, that's where you may trigger, I guess, depending on your jurisdiction, your capital gains portion. But with liquid staking, there is a kind of more nuanced approach, because it depends. Again, I'm not trying to provide tax or any advice on the matter, depending on everyone's jurisdiction. But if you do deposit, you essentially are changing the token. So you're taking ETH, you're getting a liquid staking token back. So that is effectively a change in token, which might have some tax considerations that you might trigger off the back of that. And then in addition, you would also start to earn yield on that token that's being staked. So that basically, and it's quite difficult because the way, I guess, the Ethereum network is structured is you only necessarily realize that accrued income when you actually go to pull the assets out of the protocol that you staked with. So you get your liquid staking representation, you're holding that token, but there is no clear-cut fee or interest income accrual that you can clearly see in any type of subledger. So that's where a lot of the difficulty comes into play. Obviously, for corporations, you need to be able to find a way to track your accrued income. If you're not able to do so, it can get quite difficult, and that's where like a lot of this stuff we say wasn't necessarily designed for accountants or finance people, because it doesn't show these clear accruals. It doesn't show a lot of this. So for accountants, like a lot of the work is spent on either going to the contract level, trying to give estimates based on an approximate plausible amount of interest income that they may or may not receive, and just really trying to make a best guess on the amount of income you'll receive from this position. So I think that's where a lot of the complexities come in, is how much income do I need to record, and how do I do so, and timing wise and everything like that. I think we've seen some other typical protocols on the Ethereum network might allow you to stake some assets, and you can actually see a representation of those on chain. I think it's getting better, and I think a lot of these protocols are finding ways to enable different tracking tools to tap into their database and provide better information for their users. But again, I think that still has a long ways to go, and it's going to be a little while before they put accountants at forefront of these protocol designs. So I think in the meantime, we really have to try to find some creative ways to record the interest earned on these assets.
Awesome. And I'm going to ask you a question, a very popular question we have, clients have, companies, Web3 companies have when they're trying to figure out best approaches for treating liquid staking. I understand you talked about the taxability could be different, right? Because if you're depositing crypto and then getting an LP token, you're technically doing an exchange. So maybe in some jurisdictions that's taxable, maybe in some others those events are not taxable. But regardless of the taxability there, the simple question, I mean, and maybe it's not a simple answer, but the question I want to ask you is, so once you get that LP token in your books, what are some ways you can treat that LP token, given that there's not going to be a fair market value present for any of these LP tokens?
Mm-hmm. Yeah, so I guess in that sense, those LP tokens are in relation to, I guess, providing liquidity to any kind of other pool, such as Stake Balancer, for example. Yeah. As far as the liquid staking tokens go, it's fortunate that many of them can simply just be pegged to ETH or something very close, and a lot of these protocols have designed oracles that allow for rebasing and repricing daily. So the pricing aspect is okay. But now, as you mentioned, all these protocols are built on top and allow for these natively yield-generating assets to be deposited into their protocol to provide liquidity for other users who want to trade on both sides. So that's where essentially I take my liquid staking token, I put it into a pool. Let's say it's ETH, half whatever this token might be, and now users can swap and trade against it. And for doing so, I essentially get an LP or liquidity providing token that says I have X amount in that pool. So what's very difficult, as you mentioned, Richard, is finding a value for those tokens, because there isn't any kind of price feed. They might have just been spun up. A lot of people are randomly spinning up pools. So then it becomes very difficult to value that. And that's, again, where some manual intervention kind of comes in. We can try to automate it all we can, but ultimately you need to give that token an initial cost base when you receive it. And that cost base needs to be made up of whatever assets you deposited. So quite simply, if I put 50% ETH, 50% liquid staking token, and they had, say they were both $2,000 when we put in, that would be the cost basis per unit on the LP token I receive. And then I can hold that and then redeem that at a later time. Obviously, doing that in an Excel spreadsheet or something is virtually impossible. I mean, unless you're only doing one or two, I guess I could assume that it's not too difficult to keep. But as that starts to scale, it becomes very, very difficult to track all this and all the ins and outs. And at some point, you just don't even want to do any transactions because you're fearful the reporting side that might come of it. So I think, I think that's like the major difficulty. And then obviously when you're in these liquidity pools, you are incentivized to do so. They need to incentivize someone to provide liquidity, and to do that, a lot of the time it's a portion of trading fees, or there's other external incentives that a protocol might put into that pool in order to really drive up users to put their assets in there. So then actually segregating and dividing that amount earned can again be very difficult. At which point you basically just want to record it all as a capital gains tax or something, and just include the price appreciation that you ultimately receive by the time you get your asset back. So yeah, I guess that was kind of a long-winded way of saying it, but again, it is very difficult to track those LP tokens, and I think even getting support for them, adding them to whatever protocol you're working with is very difficult, because there are so many and they continue to just be spun up daily, that it's quite hard to keep up with a lot of the activity that happens in DeFi. And I guess that's kind of crypto. People can go do whatever they want. There's no one stopping you. So we kind of have to build tools and like thought processes around that, that kind of allow for us to have more of a general approach to a lot of this than just a specific targeted per pool approach.
Yeah, that's definitely an easy question to ask, but difficult to answer.
Yeah, well, for sure. And I'm sure you guys kind of see that a lot. Like there's so many pools, so many tokens, so many different things that everyone's kind of operating in, and everyone has like this little niche of the market or the space that they are fully entrenched in. And yeah, I mean, it's a challenge to accommodate all those, but at the same time, I guess that's kind of the fun of it, because someone can go operate wherever they want.
Right, exactly. Okay, let's jump to the main ledger. That's going to be an interesting topic. So how you would push liquid staking activity into the main ledger, and by push we mean syncing journal entries into a main ledger. In this context, being a fiat ledger like accounting software like Xero or NetSuite, QuickBooks, for example. What are some of the strategies that you think are optimal?
Yeah, just I guess as far as taking all that data and then trying to put it in, mangle it into some kind of accounting form where we can clearly put it into our system and then spit it out into a lovely financial statement. Is that what we're talking about?
Yeah, exactly. So trying to get that data,
Yeah.
complex data, basically syncing it into a digestible way for a fiat ledger, essentially for statements, right? Financial statements.
Yeah. I think like if we're talking to the accountants, like I think probably the first and most challenging part is actually like parsing this data that comes through from chain, because a lot of the time you don't necessarily know what happens. It could be someone else in your team that some interaction on some smart contract and there wasn't any kind of receipt of token, or there. It's very hard to track a lot of this a lot of the time. And I think one of my biggest pet peeves is also seeing the function calls that a lot of developers create. Is basically no consistency, and they can just call any kind of function whatever they want, and then it's up to you to kind of interpret what actually happened. So I think that's kind of like the first end is obviously getting that data in correctly and understanding what is coming from the blockchain and what interaction we did, and then from there understanding how you record that correctly. If it's kind of an internal transfer from wallet to wallet, maybe that's easy. If it's a swap, it might be a little bit easier, but then if it gets a little bit more complex, like we're talking about with LP tokens, how do we segregate those? How do we ultimately classify them? And then, so once we do classify them, how do we now take it to the next step where we take these classifications? And then I guess for my personal preference, I then take that classification and I try to assign it accounting GL line item within my trial balance, which then is I guess where we kind of earn our money, trying to interpret a lot of these transactions and trying to give meaning to them in a kind of more general finance framework that others can clearly understand when they're looking at your statements. I guess for me, like I try to I try to round them all up into one account and just kind of keep one digital asset account, and that's where a subledger is crucial in my mind. Instead of jamming every single entry that happens, for those, who operate a lot in the ecosystem, they'll know there can be a ton of transactions just in one day. So in actually pushing those all through sometimes doesn't make sense. But when you have a subledger and you can see all the transactions, you can see all the classifications, you can add your notes, you can add all this stuff to it, that's when it makes a little bit more sense. And maybe that's a better way to analyze it than actually just trying to shove it into your typical accounting framework of your NetSuites or your Zeros or whatever, QuickBooks, whatever they might be. Obviously, those systems are not necessarily designed to intake transactions with 16 decimal places and any different kind of currencies. So I think that's where the subledger is really important. So classifying, giving them a line item on your trial balance, and then pushing those line items through maybe monthly helps just to get those items, those expenses, those revenues, whatever they might be, into your general ledger. And then if you want to drive down into further detail, that's where I would typically kind of look behind the scene, look at the subledger, and figure out the specifics of what happened, and try to drive some valuable insights out of that information versus, I guess, trying to push it into accounting system and then work backwards. So yeah, I guess long-winded. It's probably for me, I guess, to get into a subledger, it's a monthly thing. I'll review everything. I'll make sure that everything reconciles, that my digital asset account balance reconciles. And from there, I'll push kind of a bigger entry just to summarize all of the activity for the month, and then really rely on some kind of external service or external software that helps me track better.
For clients, for companies, Web3 companies using crypto subledgers, syncing their journal entries into main ledger, so fiat ledger softwares, accounting softwares, do you envision accountants finding it valuable to sync function calls along with their journal entries? Or do you think because anyone can create a function call, maybe it's too arbitrary?
Yeah, well, I think it's a dangerous game, especially once you start like pushing that into your financial software, whatever that might be. It might be good, but even still, like that function call is not going to tell you everything, or still a lot you have to interpret. A lot of the time, it ends up just saying something random like transfer, but meanwhile, you've done like some extensive flash loan or something where there's been a ton happen under the hood, but you just see kind of one line item. And actually picking that exact line item that you want to show is difficult. So I think that's where I think a lot of the work can be done on kind of front running, or I guess having classification rules set up so that you start to capture all of these use cases within your subledger, and then you just take that function call and you just try to automate it the best you can based on a certain set of rules that you've tried to kind of build out in your system or on typical transactions that you're used to. And then going from there, and then actually just taking that, maybe that classification is what's more important, or maybe some notes that you add on the transaction. But the function call itself is still just a product of the blockchain. And at that point, it's kind of at the mercy of whatever some developer tried to create for this function call. So I think that becomes quite difficult. I think the real value is maybe trying to automate your processes and really help yourself by creating rules for a lot of these transactions, and understanding the interaction with different contracts and what those typically mean, and then just trying to tag and auto classify and just automate as much as possible.
Yes, it seems like we're trying to see the developer world connect to the accounting world here in this instance. Would you say that
it's the accounting world trying to connect to the developer world? I think they'll continue to do their thing.
The other way around. Yeah, you're right.
Yeah.
Would you say that we're really, really early in terms of before we're gonna see any type of liquid staking reporting standards anytime soon?
Yeah, I would like to optimistically say no, it should be just around the corner, but maybe certain jurisdictions actually have put it together, like a little bit more clarity on the guidance. I know UK is doing a good job of this. I know Europe has a lot of good regulation in the pipeline. Um, some other countries, not so much, but I, yeah, I think it's still going to be a little bit before we get there. I think it's kind of going to continue to be on us to build out what we think makes sense, and kind of come to a thesis on why is this reasonable, why should we record it like this, and then just really support that opinion. I think, and in order to do so, I think people really need to understand what's going on. So I think that level or depth of knowledge is really important. And then hopefully from there, it starts to get a little bit easier. Yeah, like it's definitely something hard to just come into, pick up, and understand right away. I think it's something that you like really have to have a passion for and want to learn and want to be a part of. Um, yeah, again, I think it's with like a lot of things in crypto. The maybe the UI UX is not quite where it needs to be. So this tooling still needs to be developed, and we still need to really work on an understanding of what uh, the best way is to record these assets, and how we do that kind of collectively. I think would be great, and I think there's a good couple of groups or a good few communities now that are playing a part in that. So it's nice to have others be along for this journey.
Absolutely. I'm excited to see reporting standards come into play and see a little bit more universal type of reporting for liquid staking. I know there's a lot of countries. Some countries are ahead of others, um, but it'll be great to see a bigger consensus for sure. Uh,
Yeah.
let's uh, let's go straight into liquidity pool tokens then. In the next slide, we're talking about essentially a little bit more complex topic here. So when you have liquidity pool tokens or NFT bonds, how do you essentially set up a reporting strategy for? So we talked about the LP tokens a bit. What about NFT bonds? So this seems to be a new up and coming thing in liquid staking instead of LP tokens. Now we're getting like the LP token is being replaced by NFTs, right? To distinguish a user's position in the liquidity pool. So are we doing the same type of reporting strategy, or are we varying here because now it's an NFT instead of the typical LP tokens that we're used to seeing?
Yeah, this one gets a little bit more interesting, and we'll see how this starts to evolve. And if it does, there's a few, I guess, special things you can do with an NFT. I think a lot of people obviously think about like a profile picture or some kind of piece of art. So maybe we'll just start with saying that's not what we're talking about here. I think there's a lot of different purposes for an NFT. And in this case, it effectively serves as a wrapper around ETH. And that NFT has, you can build in some special applications to it. One being in our case, making that NFT soul bound to the user's wallet, which is interesting as far as creating kind of a collateral. So I guess the purpose of what we use the NFT for is if someone wants to run a validator that takes 32 ETH, but part of liquid staking, I guess, that we didn't get into, and maybe this is more on the operational side, but it allows them to basically liquid staking protocols allow users without 32 ETH, which can be upwards of 60K or depending on the price, even more, to come in and still be a validator on the network, but only have to post maybe a 2 ETH bond. And then they'll get the remaining ETH from the liquidity pool that this liquid staking token is kind of generated. Yeah, I probably didn't do a great job explaining that. I think it would require quite a bit more depth if we wanted to go there. But in this sense, the NFT is effectively wrapped around 2 ETH. So at that point, we do know a cost for that NFT. We know that there's 2 ETH in there. If I wanted to exit, if I wanted to get my ETH back, that's very simple to do so. So that's where pegging or taking that NFT and giving it some kind of clear-cut value, if we know that every time there's 2 ETH in there, that helps with the pricing mechanism. As we just basically know that whenever we get that NFT, we take the price of ETH, we take effectively 2 ETH in that NFT, and we times it by the price, and that gets us our value. And that will help us whenever we enter or get back out. So yeah, I would, in that way, I would treat it very similar. It's kind of a swap in assets. But I guess a case could actually be made for NFTs where maybe it isn't, because you're actually just still holding your ETH. You're just wrapping it in a different contract. So yeah, I think that one kind of still has a lot of leeway and a lot of interpretation that we need to work through. When it comes to other NFTs, I think then it gets much more complicated to give pricing. A lot of people want to just kind of take the floor price for NFT collection or whatever it might be, which is, again, quite difficult because a lot of this stuff is quite illiquid in the end. And it becomes very difficult to price anything that doesn't have a liquid market. And if you try to do so, I just think it's quite inaccurate, because if someone were to flood that market with a number of those tokens, it's going to significantly drive the price down very fast. So a lot of kind of that sensitivity analysis needs to be considered when doing that. So, yeah.
Given the difficulty in pricing these NFT bonds, due to the fact that some of these NFT bonds could be less liquid than others, you talked about liquidity being a problem. Would you say that pegging NFT bonds is still the most efficient way of reporting them in the balance sheet, or do you envision a more streamlined approach being possible in the near future?
I don't know if we'll get anything in the near future. I think longer term, there could be a lot of interesting applications for this. If the real world asset thesis comes online, I think we can start to see some other, I guess, real world assets in many cases wrapped within a similar structure. And at that point, again, the pricing is still going to be difficult. I think a lot of these are more illiquid assets for the most part, which require some kind of special pricing and can't quite be automated the same way. I'm probably missing some applications that are available, and I'm sure I'll find some over the next week or so now that I'm thinking about it. But yeah, so far, I think that's been a lot of the applications within the NFT space. But I guess within the next 5 years, I would expect to see some more iterations on that and some more liquid markets for some of these NFT structures. And that's not just, again, talking about profile pics, but actually something with hopefully some real utility and some real value that shows a good representation of either an off-chain asset or something on-chain that can be traded easily.
Objective utility for NFTs. We're starting to see a lot more financial applications for them.
Yeah.
I know we talked about this briefly, and I know that the answer is going to vary depending on jurisdiction. But just to kind of dive into the topic a little bit, sending assets to a DeFi pool, like a staking pool, for example. I understand that your approach is to, if I understand correctly, is to classify those dispositions as taxable events in the context of liquid staking, because you're technically getting a different type of crypto asset in return, whether it's a LP token or NFT bond. But do you see anyone in the industry, maybe because they have a different jurisdiction, do you see other people in the industry not recognizing the disposition as taxable and instead classifying them as internal transfers?
Yes, and I think there's a few different jurisdictions I've seen this, and I think there's a few kind of talking to some, I guess, government bodies of those countries, or just being a part of that conversation. I think there's some very good cases being made as to those should not be dispositions. I think for me, I'm not typically in a tax jurisdiction, so it's a little bit easier, I think. But I do see the case for that, because ultimately, as we talked about, if you deposit your assets, you get a liquid staking token, or you get a liquidity provided token, or something in return. But that is still a representation of what you put in there. It's not a trade. It's not a swap. You're not giving one asset and necessarily getting the other, and then you have to go back. You could effectively unwrap that whenever you want and get your underlying asset back. So I think it's a very good case to be made, that there shouldn't be a disposition on that every single time. If I just want to provide liquidity to a pool and have borrowers on the other side, and maybe I want to earn some interest on it, it doesn't really make sense if I'm still long that same asset, to actually record that as kind of a triggering some type of taxable gain or loss, or whatever the situation might be. So yes, I think there's a good case to be made on that. The other one that's kind of interesting is, obviously, once you loan that out, you are earning some kind of trading fee, some kind of yield on that token. And that might be in the way of farming, for example. So if you're getting kind of incentivized by the protocol and receiving their native token, that also gets interesting, is how you record that income and what that hits. A lot of those, as we talked about before, illiquid markets, a lot of those tokens that you might that might represent the protocol that you're providing liquidity to, you might get those from protocol emissions, and actually using those after, they might say they have a value, but they might effectively be pumping a significant portion of their total token supply into the ecosystem, meaning that if you were to turn around, you and everyone else providing liquidity, and sell it, there's going to be a significant price impact on those tokens. So that, I think, becomes quite interesting when people are receiving those, and it says that there's X price on the token received for providing liquidity. But then in theory, when you actually turn around and go sell it, that price is significantly lower, but you had to report your income or your revenue earned on that higher value initially. I think that's one that a lot of industry people are really trying to figure out a solution around, just to ensure that there isn't some significant over revenue reporting that's required, and really inflating the value and paying the tax bill as a result, when really these are somewhat illiquid assets. So it's finding a good balance where you can still participate, you can still earn these tokens, but you don't, I guess you're not disincentivized to do so because of the tax bill hurting. So I think that's a big challenge that we're going to start to see.
Okay, I see. So your personal position would be, I'm sorry, not personal position, personal opinion, would be that most of these types of transactions, these deposits into staking pools, should be more internal transfers. But you would say that the argument is more stronger towards the approach that it is a internal transfer, because you're not in practice disposing the assets yet, right? Versus what jurisdictions think you are doing.
Yeah, exactly. And I mean, that's a big educational piece, and it's pretty complicated stuff. So I think we've seen like a lot of advancements there from like regulators and whoever it might be, understanding that. But I think the case still needs to be made. I think we still really need to provide support on why we think that, and I think we can get there. But yeah, I guess that's what I would like to see, because I don't know that it makes sense every time you want to provide liquidity that should hit you with a taxable disposition. I think it's somewhat disincentivizes a lot of activity on chain.
Yeah, that's a very very good take. If we want to incentivize more financial DeFi activity, then we want to incentivize the argument that these deposits are more internal transfers. Yeah, that is a which direction jurisdictions take here could really alter the history of DeFi. So that's a quite big topic there.
Yeah, or I mean, the people who are actually trading just do it anyways, and then from an accounting perspective, we just got to figure out how to do it. But at some point, I mean, if you are incurring significant taxable capital gains or income that significantly increases your taxable income, then it may not become as profitable as it might otherwise be. So that is other things to consider.
Yeah, I think we're running a little bit low on time here, so we're going to jump to the last slide here about reporting. So we
Okay.
just want to take your time on your take on how you would use a crypto subledger, like for example, CryptoWorth, to solve some of the challenges around liquid staking reporting.
Yeah, I think it does a really good job. Obviously, we talked about tracking cost basis. I think that's a significant time saver in order to understand when your asset comes in and then when you dispose of it later, what that cost basis is tracking as. And obviously, the liquid staking token that you get when you deposit your ETH is another clear representation of the value add that a subledger can provide. I think the next kind of iteration will now be starting to have automation on the income accrual and figuring out exactly how that income starts to accrue to these different positions and having good reasonability on what we would expect for a return and all these other kind of items that might satisfy like an auditor or whoever that might be. So I think that's kind of the next iteration, but right now, I think a subledger is obviously a crucial tool in order to be able to save yourself time and ensuring that you have the accurate information and that everything is coming from on chain and can be relied on, and you're not having to kind of manipulate data spreadsheets in the background where you just leave yourself subject to more errors. So yeah, I think there's definitely a lot of value add at that point.
Awesome. Well, thank you so much for your feedback on that. Of course, it's always great to see how improvements can be done for crypto subledgers to improve reporting, facilitate tax recognition as well for these types of transaction events. So thank you so much for sharing that. So just the last page here, or last slide, we want to just thank you so much for being our guest today, Jozef. I think it's really amazing that you were able to take the time and opportunity to talk to the audience and answer all these questions of very very common questions that we see all the time. So it's great that so with your experience that you can share your findings and how you were able to address these subjects regarding liquid staking and reporting in the newest, the newest shift in the industry in this particular subsegment with NFT bonds, which is really exciting. Thank you so much for being a guest today. And yeah, and did you want to say any last things before we wrap up?
No, I mean, nothing to kind of close on from my side. I appreciate you guys having me on. It's great to kind of discuss this, and it's great to have people interested in playing a part in how this kind of shapes. So I think the more people we have with a deeper understanding and the more people we have with, I guess, tools that allow them to access all this information from on-chain and put that into their existing systems is crucial. So appreciate it.